Yeah, Kelly, the stocks of the institutional owners of single-family rental homes have just been taking a huge hit because President Trump just posted on social media that record high inflation has pushed Americans out of the dream of home ownership, especially younger Americans. And he said, "It is for that reason and much more that I am immediately taking steps to ban large institutional investors from buying more single-family homes. And I will be calling on Congress to codify it. People live in homes, not corporations. I will discuss this topic, including further housing and affordability proposals and more, at my speech in Davos in 2 weeks."
If you've ever lost a house to a cash buyer or wondered why Wall Street seems to own half the neighborhood, well, today's story matters to you because overnight, Donald Trump said the U.S. is taking steps to ban large institutional investors from buying more single-family homes. And if this becomes law, it could fundamentally change who you're competing with when you're looking to buy a house. So here's what was announced. Donald Trump, the president of the United States, came in today and said people live in homes, not corporations. The proposal targets large Wall Street firms, private equities, REITs, and institutional landlords, not everyday homeowners, home buyers, and small investors. So how's this actually going to play a role in housing in 2026? Well, that's the question we're hopefully going to answer today. So my name is Dan Frio, folks. My goal each day is to come in and explain to you guys what's going on with those and the whys behind it. Well, today we're going to talk about some breaking news from Washington. It's Donald Trump coming in saying, okay, we need to get more people in single-family homes, not corporations. But how much do really corporations own when it comes to the United States? So we're going to go back over to Diane Olick, and this was kind of a surprise to me as well, because recently I was in New York for my son's wedding and driving through there, that we drove miles and miles and miles, and I'm like, my goodness, what is that? And somebody says, oh, that's what BlackRock owns. Those are all low-income housing or something like that, and it went for miles. So is this actually going to help a lot of areas? I think some will, but in most parts of the country, you're probably not going to see that much of a recovery. Don't believe me? Let's get back to Diane Olick so you can understand how much institutional owners really own and what this might do to housing in 2026.
Key in that statement is that he would need Congress to pass something like that. But it's important to note, large institutional investors, and the biggest names are Invitation Homes, American Homes for Rent, and Progress Residential. It should be known they own less than 5% of all single-family rental homes in the U.S. They are concentrated in certain markets, which can push buyers out in those areas. But the vast majority of rental homes are owned by small to mid-sized landlords, mom-and-pop shops. But again, you can see those stocks are taking a huge hit on that, Kelly.
Yeah.
So now you understand a little bit more about the housing market when it comes to who owns it. Hopefully it was a little bit of a surprise to you. It was for me. But some areas that are really heavily concentrated, you have areas like Texas, areas such as Arizona, where companies come in and they basically buy up whole neighborhoods. So, but unfortunately, all over the country, that's not the norm. So will this help? Well, only time's going to tell. But this is at least hopefully a little bit of a reprieve if you're out there trying to buy a house in 2026. Now let's get over to the markets to see where rates are going to go. And I'll give you also some economic news that's coming down the pike in the next 2 days. And it's right in the wheelhouse with the Federal Reserve monitors. So today we saw mortgage rates, they eased just a little bit. I know I keep saying my forecast is rates between 5.875 and 6.25. We're down from the 6.25 that we were. I thought that was going to be the high for short term, and it's panning out to be that right now. So the markets right through here are working in our favor. We go over to here, and here's what the Federal Reserve monitors. And I know I go through this every day, but you have to understand these. I'll just go through these three components. Right over there, that's the federal funds rate. That's the Federal Reserve's rate that they control. That's the only thing they control. They don't control, your rate on your car loan or credit cards or even mortgages. Those are controlled by the bond market. So, but the Federal Reserve and the bond market watches these things right through here. This over here is inflation. Now, what they came out said recently, even from the Federal Reserve's head, he said that inflation from tariffs is probably a one-off. So inflation, yes, it's ticking up a little bit, but I think it's under control. That's not me talking. That's even from the Fed. They don't think it's going to run out of control. But then they came in and said, okay, now the culprit we we really want to focus in on is the employment numbers. Well, let's take a quick glimpse of what happened today in the economic news, because you always have to remember, the better the news for in the economy, the worse the chances are for a rate cut. So remember that. So we got this today, and I'm not a huge proponent of ADP, but ADP came in this morning and said 41,000 jobs were created. Why this was good headlines? Because the last reading was a negative 30,000. So that was great news. Then the JOLT index, how many job openings and labor transfers there are, it's actually coming down, which is good news. Also, statistics came out that said if you stayed on your job, you got a 4.4% raise over the last year. And if you changed jobs, you got 6.6. Like I said, in this morning's video, don't blame me, blame your boss if you didn't get a raise. So now here's what's going to happen. Tomorrow, we're going to get the initial jobless claims. This is from our government. So this is going to give us a little bit of a bead on what's going on there. Then on Friday, we're going to get the actual unemployment report. Now, here's what you need to look at. See this analyst reports right through here? The last number was 4.6. The unemployment rate. They're expecting it to go down. Okay, so let's flip back over to here. So if they're saying, okay, this is our main culprit for we have to cut rates because we think the unemployment rate is going to really skyrocket, and it doesn't, well, does that mean the Federal Reserve won't cut rates? Well, that might be on the table right now. So we're not seeing inflation running out of control, and we're not seeing a job market that's actually plummeting as well. So remember, the better the news, the less of a chance of a rate cut. So then if you go over to the bond market was I'll just say steady today. Bonds at +4 basically mean the market really didn't do anything. What am I talking about? Well, this bond rate through here, this tells me actually exactly what went on with the mortgage rates today, because it's a mortgage bond. But what's a little different right up through there, you're seeing the price of the bond, not the rate. So how to decipher this? If you see the price of the bond going up, that means rates are coming down. There's kind of a yin-yang effect. So price is up, rates are down. So we love when the prices are going up. So now if you're looking to, maybe refinance right now, and you're thinking, okay, Dan, you said rates in your range of 5.875 to 6.25. We're at the higher end of 6.25. So should I just wait? Well, I have a calculator right down there. There's actually a couple of them. Check them out. Use the code Dan so you get them for free. There is a calculator out there that says, what is the cost of waiting? So we know rates might go down another 0.25%, maybe in the next year. So if you wait, how much of a savings would you get by waiting? In most cases, you're going to lose out on that. So check out the calculator over there. But what you can also do is just go to our website. I actually created a tool right up there through there. It's called RateWatch 2.0. What we do is we want you to put your mortgage information in there. We don't sell it. I promise you, we don't sell it. I track it myself. So put in the rate you'd like to refinance, and when it hits there, I'll call you, I'll text you, I'll email you. We'll go over the new payments, what the costs are going to be. You got to know the cost, because you got to know what your break-even point is. If it's under a year, do it. Because in most cases, if rates go down 1/4, it's not going to save you that much more. And if they go down more, it's probably going to be a year from now anyway. So then maybe refinance again if you're saving that much money. But if you're a person looking to maybe buy in the spring, or maybe you're looking to build down the road, what should you do? Let me just give you my thoughts on where we're going to go from here. So I look at things as, should we lock in your rate or should we float you? Well, if you have a rate right now it's over 7%, please reach out to us. Okay, go to therateupdate.com, give us a call, email us, because we want to see how much of a savings you can have right now. Most cases, people are saving over $500 a month in their payments, and we're saving them over 1.3% on the rate. So if you're over 7%, check out right now. You might want to lock in at these rates before they don't move. You're paying that high rate for much longer, or maybe they go up a little bit from here. But my thoughts are, if you're looking to buy, down the road or build, just float. Okay, so here's why. We're going to have a new cast of characters at the Federal Reserve. The Federal Reserve chairman, he's resigning, or he's actually retiring in May. We have another person retiring in February. That means 2 new members of the Fed are going to be handpicked by the president. So what's the most likely outcome that he's going to pick? He's going to pick people that want to cut rates. So rates are probably going to go down a little bit, but as you know, few times in the past, even when the Federal Reserve cut rates, mortgage rates jumped. So I'm still saying just float in if you're looking to maybe close in the next couple months or the latter part of the year. So now let's get over to see, how did the markets react to this? Well, the Dow Jones took it on its chin today. So today is not that Cinderella story we were looking for. Dow Jones down almost 400 points. S&P down 15. NASDAQ upped a little bit. Russell's down. So basically, I'm just going to go across the board. Other than the Dow, which the Dow hit a record high yesterday, so There's probably some record profit taking. Other than that, it looks pretty good across the board. Oil, let's see what oil is doing. Oil is down also. So I'm surprised oil's down. Anything below $60 a barrel, we're giving double thumbs up because that helps inflation tremendously. So now, hopefully, based on all the information I've given you with tomorrow's economic news on the unemployment numbers, what Donald Trump might do with housing, maybe now you know a little bit more about what's going on with these and why it happened today. So if you enjoy my channel, folks, all I ask you to do is subscribe over there. Make sure you hit the bell too, so every time I post a video, you get an alert. And join us every Wednesday where Alan and I come in. We actually show you kind of our slogan. Here's who I am and what I do, folks. My name is Dan Frio. I'm actually a licensed mortgage loan officer in all 50 states as well as Puerto Rico. The cool thing about this is the bank that I work at provides me that license, but we're also set up with over 30 different lenders. Why? Well, like I said, the name of our channel is the Rate Update. So we want to update you with rates. So when you're calling us, you want as many options as you can. So what we did at the bank, set ourselves up with over 30 other lenders. These are banks, credit unions, and mortgage companies to make sure when you call us, we're doing all the heavy lifting for you. So we're going to compare your loan with over 30 different lenders. Make sure you're getting the lowest rate and lowest fees in the industry at this time. And that's what we do. So thanks for watching. Please make sure to subscribe over there and join me and Alan tomorrow at Behind the Scenes on how we compare your loan with over 30 different lenders. Thanks for watching, folks. God bless. Have a fantastic evening and be safe out there. And I'll see you tomorrow morning at the opening bell to let you know how all this stuff starts another day. See you then. Bye-bye.